Something just changed in XRP that matters more than it looks. Two separate forces that have been suppressing crypto for months are suddenly moving in the same direction, and the market's beginning to react. In this video, we'll break down why a major geopolitical development and a potential regulatory breakthrough could be reshaping the environment around XRP, what most investors are still missing, and why the biggest story may have nothing to do with today's price action. See, XRP was up roughly 10%, but that's not the most important part of the story. The real story is what may be causing that reaction. For months, crypto markets have been dealing with two major sources of uncertainty. The first is geopolitical risk. The second is regulatory uncertainty in the United States. Both have acted like pressure on the market. Both have limited confidence, and both may now be starting to ease. That's important because markets don't usually move the most when good news arrives. They move when uncertainty disappears. And right now, investors are watching two developments that could remove barriers that have been holding back not only XRP, but the broader crypto market. One involves the Middle East and one of the most important oil transit routes on Earth. The other involves Washington, the future of crypto regulation, and a shift that institutional investors have been waiting years to see. And when you connect these stories together, a much bigger picture starts to emerge. To understand what's happening, we need to zoom out. Most people assume crypto prices move because of technology or partnerships or adoption announcements. And while those things matter over the long run, short-term markets are usually driven by something else: sentiment, confidence, fear, uncertainty. Markets don't simply rise because good news appears. They rise when uncertainty disappears. And for months, two massive uncertainties have been hanging over crypto. The first was geopolitical. The second was regulatory. Now both are showing signs of improvement. And that's why this moment matters. Because short-term noise creates volatility. Long-term structure creates trends. And right now, the structure may be changing. Quick disclaimer, this content's for informational, educational purposes only, not financial advice. With that said, let's continue. Let's start with the geopolitical catalyst. Recent reports suggest a potential framework agreement between the United States and Iran is moving forward. The details are still developing. Nothing's guaranteed, but markets reacted immediately. Why? Because investors aren't just watching politics. They're watching the Strait of Hormuz. For those unfamiliar, the Strait of Hormuz is one of the most strategically important waterways in the world. Roughly 1/5 of global oil supplies move through this narrow passage. Think about that. Around 20% of the world's oil flows through a tiny choke point. Any disruption comes immediate concerns about energy prices. And energy prices influence almost everything else: inflation, interest rates, consumer spending, corporate profits, risk appetite, including crypto. When fears of disruption increase, oil prices often rise. When oil rises sharply, inflation concerns flow. And when inflation concerns rise, central banks become less willing to cut interest rates. That's where the chain reaction begins. Now, this is what most people miss, and this is why oil matters to XRP. Oil doesn't directly affect XRP, but it affects the environment XRP operates in. Higher oil prices can lead to higher inflation. Higher inflation can keep interest rates elevated. Higher rates tend to pressure risk assets, including stocks, including crypto, including XRP. So when markets saw signs of a potential diplomatic breakthrough, oil prices began easing, and investors immediately started recalculating risk. Could inflation pressures soften? Could central banks get flexible? Could financial conditions improve? Those questions matter enormously because every risk asset on Earth benefits when financial conditions become easier, including XRP. Prices reacting, but the system is evolving. History gives us an interesting lesson here: the Suez Crisis. Back in 1956, the Suez Crisis disrupted one of the world's most important trade routes. Global markets quickly realized something important. Strategic choke points don't just affect transportation, ladies and gentlemen. Let that sink in. This is massive. They affect entire economies. The disruption created uncertainty across energy and trade markets, and uncertainty became the real economic cost. The lesson: markets often react more to the fear of disruption than the disruption itself. Today, the Strait of Hormuz serves a similar strategic function. Different era, different geography, same principle. When uncertainty decreases, markets often breathe a sigh of relief. And that's exactly what investors are watching right now. If you're enjoying breakdowns like this, make sure to like and subscribe to the channel, share and comment. It helps the channel out a lot. Now, with that said, let's continue because the next part is where it gets more important. Here is where it gets really interesting and spicy. The geopolitical story may grab headlines, yet it might not be the most important development because the second catalyst is potentially far more powerful. And unlike geopolitics, this one could have lasting consequences. We're talking about regulation, specifically crypto regulation in the United States. See, for years, one question has dominated institutional discussions. What exactly is a cryptocurrency? A security, a commodity, something entirely different? The answer sounds simple, but trillions of dollars depend on it. See, here's the regulatory problem. Institutional investors don't operate like retail traders. A hedge fund manager can't simply wake up and decide to buy billions in crypto. Neither can a pension fund, neither can a sovereign wealth fund. They need legal certainty, compliance approval, risk frameworks, governance procedures, clear rules. And for years, crypto lacked those rules. Instead, the industry found itself trapped between competing interpretations. The SEC frequently argued that many digital assets resemble security. The CFTC often viewed major cryptocurrencies as commodities. The result? Confusion. And confusion creates paralysis. When nobody knows the rules, institutions wait. Why this matters, ladies and gentlemen, I want you to imagine building a skyscraper. Would you begin construction before knowing the zoning laws? Of course you wouldn't. That's exactly what institutions have faced in crypto. The technology may be attractive. The opportunities may be enormous. But without regulatory certainty, large organizations simply cannot move forward confidently. This isn't because they're anti-crypto. It's because they have fiduciary responsibilities, compliance teams, legal departments, risk committees. Every decision must survive scrutiny. And until now, crypto has struggled to prove that certainty. The Clarity Act. Now, this is the conversation when it begins to start changing. See, the proposed Clarity Act aims to establish clear definitions around digital assets. It seeks to answer questions that have lingered for years. What qualifies as a commodity? What qualifies as a security? Who regulates what? How should digital assets be categorized? Blah, 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 blah. Most importantly, it aims to create legal clarity through legislation, not temporary policy, not changing interpretations, actual law. And that's a crucial distinction because policies can change with administrations. Laws are much harder to reverse. See, institutions know that, and that's why they're watching closely. Think of today's crypto market like Europe before standardized railway systems emerged. Different regions had different track gauges, different rules, different standards. Trades existed, but scaling was difficult. Then standardization arrived. Suddenly, transportation became dramatically more efficient. Capital could move faster, commerce expanded. The tracks themselves didn't create economic growth. The standardization did. Crypto may be approaching a similar moment. Not because regulation creates innovation, but because clarity allows innovation to scale. So here's the CFTC shift. Recent comments from the CFTC leadership suggests a meaningful shift is underway. The message is increasingly clear. The United States wants to remain competitive in digital assets. Regulatory clarity is becoming a strategic objective. And perhaps most importantly, there's growing recognition that clarity must survive political cycles. That matters because one of the industry's biggest frustrations has been regulatory uncertainty, changing every few years. Businesses need stable rules. Investors need predictable frameworks. Developers need confidence. The market is finally seeing signs that those foundations may be forming. See, why XRP is different. Now let's talk specifically about XRP, the anointed one. Because not every crypto assets benefit equally from regulatory clarity. This is where XRP's story becomes particularly interesting. For over a decade, Ripple has focused on institutional infrastructure, cross-border payments, settlement systems, enterprise partnerships, financial institutions. See, whether you love XRP or hate XRP, one thing is difficult to dispute. Its ecosystem has spent years preparing for institutional adoption. And that's a key distinction. Many projects are still searching for real-world integration. XRP has spent years building towards it. But the real shift came when investors started recognizing something important. Institutional demand doesn't disappear. It waits. Think of a coiled spring. Pressure builds, energy accumulates. Nothing appears to happen. Then suddenly, the constraint is removed and the movement follows. And that's the metaphor many XRP supporters use today. Not because adoption is guaranteed, not because price is guaranteed, but because institutional interests may have been constrained by uncertainty. Remove the uncertainty and behavior could change rapidly. History offers another fascinating parallel, ladies and gentlemen. See, following the Great Depression, major reforms reshaped American finance. One of the most influential was the Glass-Steagall Act and framework. But the people agreed with every aspect of it wasn't the point. The key outcome was clarity. Finally, institutions understood the rules of engagement. Financial institutions had to understand this, because if they didn't, they had nothing. That clarity helped rebuild confidence throughout the system. Today's crypto market faces a similar challenge, not a lack of technology, a lack of certainty. Markets often grow fastest when participants understand the rules. See, why institutional capital matters, you might ask. Now, this is what most people miss. Retail investors can influence price. Institutional investors can influence structure. There's a difference. Retail flows create momentum. Institutional flows create ecosystems, custody solutions, treasury allocations, settlement networks, infrastructure investments, long-term adoption. When institutions enter a market, they don't just buy assets, they build around them. And that's why regulatory clarity matters so much, because institutions need permission, structures, before deploying capital. Imagine a medieval citadel for a second, protected by massive walls. Merchants gather outside. They want access. They see opportunity, but the gates remain closed. The city isn't lacking demand. It's lacking access. And one day the gates open. Trade accelerates. Commerce expands. The opportunity was always there. The pathway wasn't. Many investors view crypto regulation the same way. The demand may already exist. The infrastructure may already exist. The missing piece has been access. Short-term noise versus long-term structure, ladies and gentlemen. Let's separate what is temporary from what is structural. Temporary signals potential Iran negotiations, daily market volatility, short-term sentiment swings, oil price fluctuations, structural signals, regulatory frameworks, institutional participation, legal clarity, infrastructure adoption. This distinction is critical because markets often confuse the two. Short-term noise creates headlines. Long-term structure creates trends. And right now, both catalysts are working together. One is reducing fear. The other is potentially removing barriers. That's a powerful combination. So here's some risk investors should remember. Of course, balance is important. Nothing here is guaranteed. The only thing that's guaranteed is death and taxes. The geopolitical situation could deteriorate. Negotiations could fail. Oil prices could reverse. Legislation could stall. Political priorities could shift. Investors could always distinguish possibility from certainty. Some analysts believe these developments could accelerate adoption. Others remain cautious. Both perspectives deserve consideration. That's how responsible analysis works, ladies and gentlemen. That's how you don't get caught up like sushi. Because investing is about probabilities, not guarantees. So here's the real takeaway. When you zoom out to 30,000 feet, this satellite perspective we always tell you about, a fascinating picture emerges. One catalyst is reducing macroeconomic uncertainty. The other is reducing regulatory uncertainty. Both have weighed heavily on crypto markets. Both are showing signs of improvement. And XRP sits directly at the intersection of these changes. Not because it's the only asset that benefits, but because the entire value proposition has long centered around institutional integration. That's why so many investors are paying attention. Not to today's price candle, not to tomorrow's headlines, but to the possibility that the environment itself is changing. Prices reacting, systems evolving. And sometimes those are two very different things. See, the biggest opportunities in financial markets often emerge when structural changes are still being underestimated. Today, most people are focused on short-term price action. But behind the scenes, two major forces may be reshaping the landscape. A potential reduction in geopolitical risk and a growing push for regulatory clarity. Whether these developments ultimately deliver remains to be seen, but they are worth watching because if they continue moving forward, the conversation on XRP could look very different over the coming years. Not because of hype, not because of speculation, but because structure. Write that down. You enjoy these breakdowns and you hold a position in XRP, ICP, HBAR, and you want to hear the satellite perspective every day, make sure to subscribe, hit the like button, turn on all notifications, and let me know in the comments, do you think regulatory clarity is the biggest catalyst for XRP? Or is this market still underestimating the macro picture? As always, ladies and gentlemen, thank you very much for watching. I'll see you in the next video. Ladies and gentlemen, I hope everyone's having a blessed day and evening. I want to welcome all the members of Patreon, the Crypto Public Desk Monthly, all the members of the membership channel. Looking back at last week, our community watch list saw some strong momentum. Approximately 85% of the market setups we highlighted in our tips and the pits achieved an average gain of over 10% over the course of the week. We also saw our technical analysis on XRP, the anointed one, play out closely to our expectations. Last week, we identified a potential near-term support level at $1.10 with a one-week target of $1.30, with the market successfully reached today. Ladies and gentlemen, to help you navigate these markets further, we have an exciting update for our monthly desk members in the Crypto Public Desk Monthly and our Patreon. This Sunday, we are launching our first live interactive Zoom session. These sessions will feature a live Q&A where we can connect directly, discuss market trends, and address the specific topics or charts you want to look at. If you're a Crypto Public Desk Monthly member, keep an eye on your inbox for the access link. And if you want to join, ladies and gentlemen, do join the Crypto Public Desk Monthly. Again, one tip from the pits can pay for your entire year subscription. Come and join over 580 active traders, investors who have taken their destiny into their own hands. Doesn't matter if you're new, seasoned. Always remember, ladies and gentlemen, the analysis and setups discussed in this video are for educational and entertainment purposes only. Trading stocks and cryptocurrencies involves significant risk, and past performance is not indicative of future results. You always got to consult your own licensed professional advisor before making any investment decisions. But ladies and gentlemen, if you feel the need, do you want to learn how to trade? Do you want to learn how to invest? There's never been a better time to learn. See, I was taught on the floor of the New York Mercantile Exchange, the first lesson, teacher opens the door. Student comes in. If you found the Crypto Republic Monthly, you've already entered. If you found the Crypto Republic YouTube channel, the door is open. It's whether you want to come in or not. A lot of people ask me what's the right tier for them. It depends on where you are at in your journey. If you're brand new, if you want to be part of the massive group chat with everybody, depending on all these things. But again, you have to understand something. The noise in the market is always going to be there. It's whether or not you want to hoist your sail and let the wind take you to where you want to go. I decided that at 15 years old. After I put down my Lord of the Rings books, and I was addicted to the market. If you're looking to learn, if you want to learn to trade and invest, come and join the Crypto Public Desk Monthly, ladies and gentlemen. There's never been a better time to learn. I tell you all these things in the market because look what happened today, right? The market's celebrating. I think it might be missing the biggest point. I want to begin with a simple question. What if the biggest market rally of the year is based on a deal that doesn't actually exist? I spent the better part of last week with family offices that I have worked for many years, and a lot of family offices that they have referred our organization to because people want to be able to take advantage of what's happening. When you're at certain levels, most people tell you what you want to hear. The people that retain us, that we work for, they're not retail people. They got to where they were by hiring the best talent. Again, I keep telling you that most of the people that I work for outright don't like me. They like my tactics and results. That's all that matters in this game. This is a game. Because what appears to be exactly what people are looking at today. Brent crude is down more than 4%. Bond markets are rallying. U.S. equities futures are green. Risk assets are celebrating. And yet when you actually dig into the details, the thing everyone's calling a deal isn't really a deal at all. It's a memorandum of understanding, an MOU. It's a framework to discuss a future agreement. See, in the mining and refining business, we're all very familiar with MOUs. I don't know if most people really know what that really is. See, it's essentially an agreement to continue negotiating for another 60 days. And that distinction matters because markets are currently pricing certainty like, yeah. What exists in reality is uncertainty. No! There's a very big difference between those two things, ladies and gentlemen. Now let's walk through what we actually know. The United States, Iran, and Pakistan have all reportedly confirmed some of the understanding. A formal signing is expected later this week. The stated objectives are ambitious: ceasefire arrangements, reopening of the Strait of Hormuz, potential easing of sanctions, resumption of energy flows, and perhaps most importantly, a reduction in the probability of a major regional war. Good things. If all that actually happens as advertised, then yes, today's market reaction makes sense. But there are several problems. First, Hormuz isn't actually open yet. POTUS may have declared that shipping should start its engines. The reality is that the transit remains restricted until after the signing. Mine clearing operations are reportedly still underway. That means the single most important physical proof of success has not yet occurred. Not one additional barrel of oil has flowed through Hormuz because of this agreement, not yet. And in geopolitics, a week is an eternity, especially in the Middle East. We've already seen Israel in strike against Hezbollah over the weekend. We've already seen disagreements emerge regarding in terms. We've already seen competing narratives from Washington and Tehran. If history teaches anything, it's that the implication is where these agreements usually become difficult. How are you going to get this to stick? Markets are celebrating headlines. The physical world still needs to catch up. And that's where things become interesting. Because if you start reading between the lines, okay, there's some very large unresolved issues, ladies and gentlemen, again. A lot of people going to get cut up like sushi. A lot of tears. A lot of people chasing the do-re-mi-do. We trace the do-re-mi-do every day. But the biggest one is nuclear. Think about this for a moment. The entire justification for the recent escalation was Iran's nuclear program. That was the causa belli. That was the central issue. Yet from what we know so far, there appears to be no definitive resolution. Instead, we have a promise, a commitment to continue discussions, a pledge not to seek nuclear weapons, and another 60 days of negotiations. Think about this for a second. Keep telling you, death by 1,000 tweets, baby. Death by 1,000 headlines, unfortunately. None of this is financial advice, just my own opinion, and retains our organization any capacity. That is not the same thing as a settlement. That's again. It's not even close. In fact, it creates an entirely new risk. What happens 60 days from now if talks break down? What happens if one side claims bad faith? What happens if domestic politics enter the equation? Because there's another date investors should have circled on their calendar, the U.S. midterm elections. Those elections occur roughly 81 days after the expiry of the proposed 60-day negotiating period. And that timing matters. See, political incentives matter. Negotiation incentives matter. Election incentives matter. Could talks simply be extended? Absolutely. Could deadlines be pushed back? Of course. Could everybody decide that kicking the can is preferable to reopening the conflict? Very possible. But none of those outcomes represent certainty. Yet certainty is exactly what markets seem to be pricing. Hallelujah. Sing it from the mountaintop. And that's why I think today's rally deserves a closer look. Let's talk about oil. Oil is ultimately what this entire story revolves around, ladies and gentlemen. See, for months, we discussed the possibility of an oil-for-oil arrangement. The logic is straightforward. The global economy desperately needs supply. Iran desperately needs revenue. The United States desperately wants lower energy prices. Everybody has an incentive to find common ground. The market's effectively betting the additional supply will arrive. And that's why Brent has solid and sold off so aggressively. But that's a second order effect that almost nobody's discussing. The world isn't just short of oil, ladies and gentlemen. The world is increasingly dependent on everything that comes from oil. Petrochemicals, plastics, fertilizers, industrial feedstocks, transportation fuels, modern agriculture. See, entire supply chains depend upon hydrocarbons. The energy story is not simply about what drives pay at the petrol station. It's about the functioning of the industrial economy itself. And if energy markets generally normalize, that would have implications far beyond crude prices. But once again, We need actual barrels moving through actual shipping lanes before we start declaring victory. Markets are currently pricing outcomes. The infrastructure still needs to deliver them. Now, here's where things get even more interesting. Because while everybody is focused on geopolitics, another signal is flashing in the background. Speculation. Last week, SpaceX completed what is being described as the largest IPO in history. Company reportedly raised another approximately $75 billion. The stock surged almost 20% on its first day. Elon Musk's wealth has now entered territory that would have sounded absurd only a few years ago. We're now discussing trillionaire status. Think about that. A trillionaire. Whether you love Musk or hate him is irrelevant. The number itself is extraordinary. And historically, periods that produce extraordinary fortunes tend to coincide with extraordinary optimism. Write that down. That's not necessarily bearish, but it's worth paying attention to. Markets don't usually ring bells at the top. They create stories. They create narratives. They create examples that feel impossible. Then later, within hindsight, everyone realizes those examples were symptoms rather than causes. History is full of them. Railroads, telecoms, dot-coms, housing, crypto, artificial intelligence. Every cycle has its symbols. The question is whether we're observing another one. And that brings me to perhaps the strangest coincidence of them all. The New York Knicks have just won the NBA championship. Now, before you click away, bear with me. The last time the Knicks won was 1973, and that year also happened to precede one of the greatest energy shocks in modern history. The Yom Kippur War, the oil embargo, a brutal bear market, a collapse of confidence. Now, I am saying the Knicks championship causes recessions? No, of course not. But market history is filled with these bizarre little markers that become memorable because they happen near turning points. And what they remind us is the periods of maximum optimism often arrive immediately before periods of maximum uncertainty. Nobody feels nervous at the top, ladies and gentlemen. I told you I don't care who wins basketball. I don't care. It doesn't put money in my pocket. What I just told you is what I pay attention to in timelines, what I put in. That's the point. The top feels fantastic. Now, let me be clear. I'm not predicting an immediate crash. I don't see sufficient evidence for that. Credit markets aren't screaming panic. Economic activity remains resilient. Liquidity conditions remain supportive, and geopolitical risks have generally declined from where it was only a few weeks ago. Those are all facts, but I do think investors should ask a simple question. Ask themselves a simple question. Yes. What exactly has been resolved? Write in the comments below. Has Hormuz reopened? Not yet. Has the nuclear issue been settled? Not yet. Have sanctions been permanently removed? Not yet. Have regional tensions disappeared? Definitely not. So while markets may be celebrating the avoidance of a worst-case scenario, we should be careful not to confuse that with the arrival of a best-case scenario. Those are two very different things. The coming weeks will tell us whether this agreement is the beginning of a genuine de-escalation cycle or simply another temporary pause before negotiations become difficult again. And that's the key distinction. Because if ships start moving, supply chains normalize, sanctions ease, if nuclear talks progress, and then today's rally could look entirely different and justified. But if implications stumble, if deadlines slip, or if negotiations deteriorate, then investors, in my opinion, may suddenly realize that they bought the headlines without reading the fine print. Yeah, there might be something underneath they're not paying attention to. And that's usually where volatility comes from, not bad news, unexpected news. That's what causes people to get chopped up like sushi. The market has already adjusted to optimism. Now reality has to catch up, and that is where I'll be watching over the next several weeks. Not the speeches, not the press conferences, not the social media posts, the ships, the flows, the barrels, the sanctions, the negotiations, because eventually the numbers tell the truth. And right now the numbers haven't arrived yet. That's why I track all these things, ladies and gentlemen. These things have only been promised. I want you to understand something, and this is what I'm taking away. Again, this is not financial advice. This is just my own opinion and anyone that retains myself or our organization. See, the markets are rallying because they believe geopolitical risk has materially declined. The reported agreement is currently a framework for future negotiations rather than a final settlement. You should be writing all this down. I can't believe I give this away for free. Either can those family offices who are now will watch the YouTube channel. They can't believe I'm giving this away for free. Hormuz remains a critical variable and has not yet been fully opened. Nuclear issues appear unresolved and have been deferred into a new negotiating period. Oil markets are pricing future supply improvements. before those supplies physically arrive. That's even more insane. Equity markets are celebrating certainty while the underlying situation remains uncertain. Ladies and gentlemen, large speculative milestones, including the SpaceX IPO and trillionaire wealth creation, suggest elevated investor optimism. Implementation risk remains significantly higher than current market pricing implies. What I'm going to be paying attention to, again, this is my free recce, not financial advice. If you're writing all this down, you're so far ahead, or just print out the transcript. Physical shipping traffic through the Strait of Hormuz, daily oil export volumes for the region, changes to sanctions, enforcement of frozen asset policies, statements from Iran regarding nuclear negotiations, Israel and Hezbollah military activity, bond market reactions versus equity market reactions, energy inventory data, and refinery utilization rates, signs of stress or compliance in volatile markets. Whether the 60-day negotiation period is extended, any divergence between political announcements and real-world energy flows. Why I think this is important? I think this is very important because energy remains the foundation of the global economy. The Strait of Hormuz handles a substantial share of global oil and LNG. Changes in energy flows affect inflation, interest rates, manufacturing costs, food production, transport networks, corporate profitability. See, if this agreement succeeds, it could reduce one of the largest geopolitical risks facing markets today. If it fails, investors may discover that current pricing reflects optimism rather than reality. Either way, the next 60 days could have consequences far beyond oil prices. They could influence inflation trajectory, central bank policy, equity valuations, bond markets, global growth expectations heading into the final quarter year. And that's why the story matters more than most people understand in today's rally. Ladies and gentlemen, if you are looking, do you want to learn how to trade? Are you looking to learn how to trade? Do you want to learn how to invest? Are you looking to learn how to invest? Come and join the Crypto Public Desk monthly, okay? I set the table for you every day in all videos. We'll have another video tomorrow at 1:30, and then this is going to come out a little later than 7:30. I'm just recording it right now. I tell you what we're watching. I tell you how I find what we're watching. But inside the Crypto Public Desk monthly, I set the full table, price points, risks, analysis, stop losses, take profits, rationalization. That's learning how to take one tip from the pits to pay for your entire year subscription. Also, we go over investing for a 3 to 5 year timeline, equities, commodities, everything. This is how you don't get cut up like sushi. I'm going to give you the line again, like what was said to me when I started on the phone, the New York Mercantile Exchange. Teacher opens the door. It's the student who has to decide to come in and commit to it. I love you all, ladies and gentlemen. I'm going to see you on the front lines. This content is for informational entertainment purposes only. It's not financial advice or recommendations. Always do your own research. Never invest based solely on a YouTube video. I love you all, ladies and gentlemen. I'll see you on the front lines. This is why we're financial mercenaries on the remora. We're swimming underneath it. Today was a very, very important video. I love you all.